explain this to me. What I can't understand about this as an outsider to the gold markets is gold is usually the thing that you have for a flight to safety. If stocks look wobbly, if you're worried about the market declining, you go to gold for safety. But we've got the stock market on this incredible tear, and yet gold is also on this incredible tear. Explain how that's possible.
Well, Eamon, it's really interesting. I think, this is the original gold, not digital gold as in Bitcoin, but the original gold for many, many years, decades, if not hundreds of years, was utilized as an inflation hedge. And what we're seeing is that it's not just momentum in this. You could argue that gold is overbought. You could argue back in October it was overbought. But what you're actually seeing central bankers buying, accumulating this. In the event we see inflation kind of tick back up. It's been on the trajectory of coming down, but what's fascinating to see, gold at about $2,250, it's going to continue to surge higher because of the uncertainty of inflation. Some people like to approach it and saying, yes, with all the interest rate cuts, we're going to see a weaker dollar, you're going to see the price of gold go up. But I don't think that's the case, Eamon. I think it's more of an inflation hedge where people are concerned that the interest rate cutting will not happen this year, and that's going to move the price of gold higher.
Yeah, so as you look at gold, do you look at sort of inflation inputs? We're going to talk about gas prices later on in this hour, but do you look at those kinds of things that are going to increase inflation and say, well, if those are happening, that means the gold price is going up, that means I should get in now?
Well, there's been a dislocation. I think you bring up a great point. And I wish I had the PCE data coming out tomorrow. I wish we had it now. But
yeah,
nonetheless,
well,
you saw
no such luck, man.
Unless you're Beeks, unless you can do something from
right.
Beeks. But what's fascinating is that we saw a huge dislocation.
How's it going? How's it going, guys? Good morning. Good morning. April 2nd, 2024. Just wanted to play that little clip for you. A lot of speculation on what's taking place with gold, why it's going to all-time highs. What does this mean? Is it going to continue? A lot of news out there, a lot of media, a lot of hype about gold. And so we're going to take a look at the facts of gold. We're going to look at the real hard evidence of what we're seeing with gold so that you are very clear going forward what to expect with price and what not to expect with price, because it's all at all-time highs. So should you be expecting price to go even higher? I mean, I think that would be not a good way to approach a market like this, okay? When we look at price action and we are trying to determine whether something is a good investment or not, what we want is we want to follow the storyline of price, right? This is something that we've talked about several times. And so what is the storyline of price? What are we talking about when we say the storyline of price? Well, with every asset, there's always something that is taking place with that asset, all right? It's either the big institutions are in the process of accumulating a position, or they're in the process of distributing a position that they've already accumulated from the past. And sometimes they're not doing either. They accumulate a little bit, distribute a little bit, but they're not doing anything with any type of sustained momentum. And to be able to determine that first and only that will give you a great edge in your trading. So when I look at gold, I look at a price action and I see that it's at all-time highs. And I've been tracking the CFTC data on it for a very, very long time. I have all the historical data. So I have all the positioning of the institutions on gold. And what I can tell you is that when I look at non-commercials, I see right at this point, they are aggressive with their longs. So the first thing I ask myself is, what size are they at? Well, I see that they are recently at 283,000. Okay. The second thing I ask is, what has happened in the past every single time the banks reached a position of this size? 280 or so forth, give or take a few thousand on each direction. Because we know that the maximum, okay, the largest size that they've ever held was 408,000. So being at 283, we still have a lot of room until they get up there. So I look back and I track what has happened at the peaks before big declines. What were the positions held by the institutions at that time? And so I look back and I look at the peaks and I can see that, for instance, at this peak, longs were 389,000. That's roughly 100,000 away from where we're at right now, okay? Because at this peak back here, you can see banks were 252,000, all right? We're just 30,000 above that. So as you can see, there was a lot more room for them to add until they got up into the 300,000s. But up in the high 300s, pretty much marking the top of gold before a significant drop in price, right? We can clearly see that. And then we had a rally up, topped out here by longs reaching about 351,000, and another top here, and price declines, okay? One more time, a little rally up here, 250,000, price declines, but not a very aggressive decline. Why is that? Because there was a lot more that they could have been adding. And they did so with this rally here, reaching 362,000 and then a decline. Okay. Rally up again. This latest massive rally that we had here saw longs reaching 321,000. That's 40,000 away from where we're at right now with gold. But they needed to take profits at that point. Big drop down. Once again, another rally, 364,000. They needed to take profits, drop down. So you can see every time they reach into the 300,000s, mid 300,000s, high 300,000s, they have no choice but to take profits on their positions. Why? Because they accumulated this position down at the lows. So when they do that, they have to take profits on those positions. They just don't keep accumulating long positions forever. And that's one of the greatest things about the CFTC data and tracking the CFTC data, is that we know the institutions don't accumulate positions forever. They get to a size that is extended from what they normally carry, and then we see them profit taking. So these clouds that I draw around price is to give me an indication of when the institutions are aggressive with their positions. The darker the cloud, the more aggressive their position. You can see they were very aggressive here. You can see they were aggressive here. Here at the highs before profit taking. Here at the highs before profit taking. Here again, slight profit taking. Once more on the way up. So when we're following the storyline of price, it is very clear that they're somewhat aggressive with their long positions right now. So do you want to be a buyer at a point where the institutions are aggressive with long positions? Yes, there is a chance that they can keep on accumulating this position until they get into the 300,000s. Do you want to take that chance? Well, better yet, let me ask you this question. Let's think logically through this, okay? Forget about what you just saw on the news. Forget about the reports and the analysis from wherever you're going to get this information, the media, all this. Forget it all. Let's think logically. What do we know to be true? That they could increase their positions into the 300,000s. So technically, they can put on another 100,000, let's say, okay? They can put on another 100,000. We reached 283. Let's go back to when there was 211. 280 minus 211, you're looking at 70,000. So from February 20 to March 12. February 20 to March 12. This is February 20. And March 12 is right here. That is 70,000 positions being added to longs, okay? That's the move that we got. Pretty aggressive, 220 up to 2180. Now, when we look at that move under a lower time frame, like, for instance, the daily, we could draw a box around it. Let's see. So would we say March here? Hold on, let's double check that. We said February 20 to March 12. February 20 to March 12, right here. February 20 here to March 12, which would be up here. Yeah, right here. That is what 70,000 positions look like when they add it. Is it possible that we get that? Yes, it's possible. But under the daily chart, all it represents is 1, 2, 3, 4, 5, 6, about 6 candles to the upside. 6 momentum candles to the upside. On the 4-hour chart, it looks like, let's see, February here and here. This is what it looks like. We have a rally, basing, rally, basing, rally, basing, rally, basing, pull back to demand, continues higher. So what I would be looking at, if you did want to trade the potential of a rally in gold, what you would want is to be looking at a lower time frame chart. Okay? You wouldn't want to be trading anything else except for the lower time frame charts. Why? Because if we were going to replicate this move that we just recently saw, okay, that's 70,000 being added, and we know that there's a chance of that being added. No guarantee, but there's a chance of it. What I would be focusing on is the lower time frame charts. So if there's going to be a potential for a move, let's say up to 24. Okay. What I would be watching for is new areas of demand being created and holding. So if I look at the chart and I'm looking for new institutional buying zones, I locate this one. Okay. And do I see any other ones? I don't. That's the latest institutional buying zone. Because technically, if you look at this rally, okay, let me just show you something. If you look at this rally and you bought and you use the latest area of demand as a spot to put your stop loss, you can see that no matter what area of demand you used as your stop loss, you would have been in the position until right here. This is where you would have been kicked out of your position. But for quite a distance up the chart, you would have been okay. Okay, holding on to a long position and moving your stop loss below every single new area of buying that came into the market. The problem with where price is right now is that the location of the latest area of demand is very far away. So unless you wanted to open up a position here and place a stop loss here, which to me wouldn't necessarily make too much sense because the distance of your stop is way too far, this is not a good time to be buying, right? To lower your risk and increase the odds of your trade working, you would need price to come a little bit lower or rally up, creating new areas of demand on the chart. And once those areas are created, you could place your stop loss below and ride the wave to the upside. But your focus would have to be on this lower time frame chart, simply because, as I've just displayed to you, this move here happened with 70,000 long positions being added. It's possible that they could add another 100,000, which would give us enormous momentum to the upside. But your risk would have to be managed by demand coming in on this time frame. All right. So this is the way you should be looking at the chart. All right? This is the way you should be looking at it. There's no other way you should be looking at it, because you're taking into consideration what's actually taking place with price. You're following the storyline. You're looking at the data. You know what is possible, what it looks like if it were to play out, and you have a logical way of managing your risk. Okay. I got a question. What tool do you use to draw the clouds? It's this tool right here, the polyline. And I just go around price and click, 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 and create the tools. And then you close it, okay? And then I have different shades that I have depending on how aggressive their positions are. That way I can just look at price and I can see what they're doing. Last thing I'll mention is if you take a look at the positions of retail traders, you can see they were aggressive with shorts here. So the banks use that as a moment to push price even higher. And then so they offloaded their shorts for longs. Okay, and then they slowed things down here. And then it's just been a steady rally. When you look at the positions as of late, there hasn't been anything very aggressive. Low 70s, mid 60s, nothing in the 80s like we saw here. Okay. So in terms of retail sentiment, there's nothing really to that has been triggering any type of momentum in the markets. This is purely buying, from what I'm seeing, by the institutions. And again, you know, it's clearly can be seen when you look at the CFTC data. Okay. Now, again, if you're following the commercials, like some people tell you, you would be looking at these huge short numbers here. Okay. 310, 347, 355, 360. You'd say to yourself, oh, they're massively increasing short positions. I guess I should short. Yeah, well, how well is that doing for those retail traders that are looking at the CFTC data in that way? Not very well, okay? So again, personally, I'm not a big fan of buying something when it's at all-time highs. I don't think, you know, there's good odds in trading. But if I were to trade, this is the approach I would take because it's logical. It follows the reality of what's taking place, and the odds would be stacked in your favor of it actually working out. You know, if price starts to decline, you want to be out of this thing the second you're not supposed to be in this any longer. Okay? And that means as price is rallying up, the latest area of demand, you put your stop loss below it. That way, if price comes down, wherever you got into the position, you make that profit until your stop gets hit, and then you're out near the highs. So if this comes tumbling down, once longs reach in the mid 300,000s, if that's where it goes, this will come down very, very hard. You want to get out near the highs as high as possible before this thing comes and runs over you. All right. So that's my 2 cents for today, folks. I hope you enjoyed it because I get a lot of questions regarding gold. And that's what I have to tell you regarding gold. Okay, that's the scenario. That's what you should be watching for. And if you're going to be trading it, that's how I would do it. Otherwise, I would just be sitting on the sidelines and trading other assets that are higher probability. All right, ladies and gents, that is it. Hope you enjoyed it. Thank you very much for joining me this morning, and hope you have a great day. We'll see you tomorrow morning, all right? Take care, everyone.